Hello and welcome to the Accountant's Movie Review, where we sift through popular movies to find those accounting hidden gems within which other reviews have almost certainly left you without. We're going to continue here on Ghostbusters, where you will remember that these four individuals found a business need within the community, that need being the fact that there is an increase in paranormal activity, and they believe that they can both catch and contain the ghosts, and that is the platform on which they're going to build their business and make money on that. And of course, we will focus on the most interesting aspect of that, the accounting. So, first transaction they're going to have here is they got a loan here. That gives us the Slimer balance sheet at this point in time, being that they have cash. There's their cash. They got the liabilities. There's their liabilities. That's what they have at this point. Next, what they're going to need is, of course, a building. Here's an old fire station that they will eventually purchase. Now, it's not clear as to what type of transaction this is or the cost or the prices that are involved in this transaction. And although it does say sale on the building, we are going to record this as a rental agreement or a lease agreement for multiple reasons. One, it's going to be a bit more simplified to do so. And two, although Egon states in the movie that the building should be demolished due to the fact that there's substantial fatigue in all load-bearing members, the wiring is substantial, and the neighborhood is equivalent to a demilitarized zone, it does appear that the building is quite large in terms of square footage, and it is in the downtown area, and therefore you would think that it would cost more than basically they have by quite a bit. And therefore, for those two reasons, we're basically going to put it on there as a lease at this point. Now, this lady on the left-hand side is the agent, the real estate agent, who is not happy about this discussion of Egon and Peter talking about the fact that the building should be condemned, but she is much more happy when Ray slides down the pole here and saying that he wants to move in tonight and sleep here tonight, indicating that the transaction has been completed. That makes the agent a much more happy here. Transaction is soon completed, and once again another transaction happened that may not have been negotiated as well as it could have been. Now, once again, we're going to assume that it's going to go on there not as basically an increase in the asset of building, but as a rental or lease. We're going to put the down payment on first. So we're going to say that cash was paid at the time of the agreement, the time the lease was signed, and that's going to be a decrease in cash. We're going to debit the down payment. Down payment's an asset up here. It's up here in the asset area. It's not an expense. Why isn't it rent expense? Because they haven't lived in it yet. They haven't used it. Once they use it at the end of the month, then it'll be an expense. Right now, it's going to be the down payment. They should get that down payment back again at the end of the rental period, unless, of course, there's damage to the building, which could quite be possible to happen. But at this point in time, that hasn't happened. They should get it back. So this is where we stand. We got cash. We got the down payment. We got the loan. Nothing on the income statement at this point. Slimer balance sheet looks like this. We've got cash. We've got the down payment. And we have the loan. Next thing that happens is they're going to have advertising here. So they got the advertising on the old 80s TV set. And I'm just going to assume that they paid cash for that advertising. Make it easy with a nice $1,000 cash payment. Cash, of course, goes down by the $1,000. And then we're going to have our first transaction that affects the income statement down here. Advertising expense going up. What does that do? If we pull over all the numbers, we have cash, we've got the down payment, we've got the loan, we've got the advertising, debits equal to credits, and we have this loss now that has happened because we don't have any income yet. We've got income minus expenses, so we have the loss of the $1,000 related to the advertising, which was just purchased. Now we're going to take a look at the financial statements now, just as if the year had passed and they had just this one transaction and they had this loss. What would the financial statements look like? And if we look at the Slimer balance sheet, we have this familiar, we have the cash, we got the down payment, we've got the liabilities. And then the interesting part is this partnership equity section. You'll notice that we have 3 partners now. That's the difference between a sole proprietor and the partnership. We have a total of this $1,000 loss in there, but you might be saying, what is this allocation happening? Why didn't we just allocate that 1,000 divided by 3? That could be one allocation method, but we'll take a look at some other methods of allocation that could be used within a partnership. Before we get there, let's take a look at the income statement really quickly. We've got no income, we've got the advertising, therefore we have a loss. Income minus expenses, $1,000 loss. Again, we're going to assume the next step as if the entire year had passed and we had a $1,000 loss for a year's period, and see how we would then maybe possibly allocate that 1,000 to the 3 partners, these 3 partners here. How would we allocate it out? You're probably saying, well, you should take it 1/3 of it. We should take 1/3 divided by 3. And that is one option. Because remember, in a sole proprietor, we'd only have one person. We would just allocate that 1,000. But now we've got Egon, we've got Ray, we've got Peter, and you'll recall that Ray had to put down personal property on this in terms of collateral. And that's a substantial risk to Ray. So it's often the case where partnerships are going to have some kind of difference here, in that one person might put in more money than another, or one person might be much more skilled in the area that they are going into. How can we basically format a partnership agreement to compensate that one individual more for the risk they're taking on or the skills that they're putting in? A partnership agreement has a lot of flexibility to deal with that. One way here we could say, okay, Ray, we're going to give you your 68,525. That's how much you have collateralized on the loan that you're putting added risk into. What if we give you a 10% return per year on that, and of the income we allocate 6,853 to you until we pay off that loan? That's one way that we can consider this. Now again, we're assuming that after an entire year we have this loss of $1,000, and if that was the case, if the year had passed and we have a loss of $1,000, how would we allocate income to Ray of this 6,853 when we had a loss on the year? Quite possible to happen for new businesses. Well, we could say, okay, we're going to allocate this 6,853 to Ray, and then we got to allocate the difference to everybody else evenly, depending on the agreement. So we have 1,000 plus the 6,853 we allocated to Ray. Now we have this amount divided by three partners that we're going to divide out evenly. Comes out to 2,617 or 8 if we round. So we're going to say, okay, Egon has 2,618 basically that he would owe to the company if the company had a net loss of 1,000 at the end. We're going to allocate that same 2,618 loss to Ray, but Ray was already allocated this 6,853, so he actually has the company owing Ray money a positive capital balance of 4,235, and then Peter, we're also going to allocate this loss, or the Peter owing the company this 2,618. If we add up this 2,618 plus the 4,235 plus the 2,618, that's our $1,000 here within rounding of like $1. And that's how we could come up with this allocation method. And again, this is very common. It's very common that we could have partners that have different allocations within the business in terms of capital, in terms of how much time they're going to spend in the business. And there could be a lot of different flexibility within a partnership for an allocation such as this. So if we go to our Slimer balance sheet, then that's how this allocation could happen on the Slimer balance sheet. Going forward, we're going to analyze some more transactions, of course, some more exciting transactions, including the purchase of a car, the hiring of an employee, and of course their first business transaction where they actually get paid, which is an exciting event.